The four financial statements are the income statement, balance sheet, statement of changes in equity, and cash flow statement. In this video, we will go through the statement of changes in equity. As the name implies, the statement of changes in equity shows you how each equity account has changed over the financial period and the transactions causing the change. To recap, equity comprises of share capital, retained earnings, and reserves. This is how a statement of changes in equity may look like. We will list the individual equity components in the columns. The rows will list the starting balance, ending balance, and transactions that cause the equity component to change. I would like to emphasize that the figures in the starting balance and ending balance must match the balance sheet figures. Before I show you an example of a company's statement of changes in equity, let's go through some examples of transactions that touches the components of equity and how we present it in the statement of changes in equity. First, we will assume the company issued shares. The journal entry to record this transaction is to debit cash and credit share capital. Cash is an asset, and share capital is an equity account. By crediting share capital, we are increasing the share capital. So to record this in the statement of changes in equity, we will write issuance of share on the left column and put the amount of shares issued in the share capital column like this. At the end of the financial period, the company will transfer the profit for the period to the retained earnings account, debit profit or loss, and credit retained earnings. Retained earnings is an equity account, so we will put the description profit for the period on the left column and key in the profit for the period in the retained earnings column. If the company adopts the revaluation model to value its property, plant and equipment, it needs to revalue the property, plant and equipment from time to time. FRS 16 on property, plant and equipment specifies the rule as to whether a revaluation should be recognized in equity or in profit and loss. Anyway, if it is recognized in equity, the journal entry is to debit property, plant and equipment and credit capital reserve. Property, plant and equipment is an asset. Capital reserve is a reserve account, which is a part of equity. So like for the previous two examples, write the description for the transaction in the left column and write the figure in the reserves column. I want to caution you though that when preparing the statement of changes in equity, watch out for transactions that affect more than one component of equity but causes no change to equity on the overall. One such example is the declaration of share dividends, where we debit retained earnings and credit share capital. Both the retained earnings and share capital accounts are equity accounts. By debiting retained earnings, we are decreasing the retained earning, and by crediting share capital, we are increasing the share capital. It will look something like this if you put it into the statement of changes in equity. I want to draw your attention to the brackets in the retained earnings column, representing a decrease. More importantly, I hope you notice that in the total equity column, I put zero change for that transaction. This is what I mean as transactions affecting more than one component of equity but causing no change to equity on the overall. For such transaction, please remember that the changes to total equity is zero. Another example of transactions affecting more than one component of equity but causing no change to total equity is the transfer of funds to the general reserves. General reserve is the amount of funds kept aside from profits earned by the company to meet future needs. In other words, it is a portion of profit put back into the company to help the company when it needs the funds. Since it is a transfer of funds from profit to general reserve, the journal entry is to debit retained earnings and credit general reserve. Again, both retained earnings and general reserve are equity accounts. When we debit retained earnings, we decrease the retained earnings. And when we credit general reserve, we increase the reserves. If we present this in the statement of changes in equity, it will look something like this. Like for the previous example, the total equity column shows a zero change because this transaction do not change the total equity figure.
I am currently at Hotel Royal's financial statement. Hotel Royal is a hotel located in Newton Road. Let's go to the statement of changes in equity. Here it is. Let me zoom it in because I understand it's very small. Okay, anyway, please take note that for a company, it is required to present comparative figure for the past 2 years. Therefore, you will see a balance as at 1st January 2018, then 31st December 2018, and another one for 2019. So we'll focus on this one here, which is for the past 1 year. So as you can see, this is the balance as at 31st December 2018, the share capital, the asset revaluation reserve, fair value reserve, retained earnings, and also the total here. So you can see profit for the year. Don't worry about what is this other comprehensive income. Typically, it means it is an increase in equity that is not recognized as an income. So here you can also see there's a declaration of dividend, which affects the retained earning. And the most important thing is the figures here and here must be the same as that of the balance sheet. So let's take a look at it. So here, as you can see, we focus on the company one. The numbers are the same as what we have seen in the statement of changes in equity. For 2019, 449,771. 441,798, 2018. We come back here again, and you realize it's the same. 441,798 for 2018, 449,771 for 2019.